Hey everybody, it's Mike from Orderflows, and in this presentation, I'm going to be talking about the difference between time-based charts and tick-based charts, specifically as it applies to our new indicator, the Orderflows FlowBreaks. Now, I do realize some of you are already familiar with tick-based charts. It's nothing new. It's been out there for a while, but, for some of the newer traders, they may not be familiar with what a tick-based chart really is and how it differs from, say, a volume-based chart or your traditional your traditional time-based chart. Now, earlier this week, we released a new order flow indicator called FlowBreaks, right? And what it does is it looks for a combination of aggressive trading in a direction followed by passive trading in that same direction. However, a question I have received a few times is what market or chart type does it work best on? So today I'm going to dive into that topic a little bit deeper. Now, time-based charts are the most commonly used charts among traders, right? You have the 1-minute chart, the 5-minute chart, the 15-minute chart, the 30-minute chart, the hourly, the 4-hour, obviously the daily. Those are all based on time. So, after the end of 5 minutes of trading, boom, the bar is closed and you start a new one. So whatever happens within that bar happens. Now, there are other types of charts which are useful as well, right? And today I'm going to talk about the tick-based chart. Again, the tick-based chart has been around for a long time. It's nothing new, but I want to show you some of the differences that you're going to see on a tick-based chart versus a time-based chart. So again, while a time-based bar on a time chart is constructed based on what trades in a specific time period, a tick-based bar on a tick chart is a predetermined number of transactions in a bar. So in other words, right, if you have a 100 tick chart, each bar would have 100 transactions. But here's where it gets interesting. Each transaction could be a different volume. Now, most of the time, the volumes are 1 or 2 contracts. Especially nowadays with the execution algos, they really got ways of chopping up a big order into small orders to sort of hide what they're doing in the market. However, obviously once it trades, it trades. But there will be times where bigger volume trades, right? Like a 50 contracts or 100 contract trade that just goes through in one clip. So while you have a 100 tick chart, each bar's individual volume will vary. One bar could have a volume of 110, while the next bar can have, a volume of 353. So the important thing to remember is not all transactions are the same, right? Again, one transaction could be for one contract, whereas the next transaction could be for 85 contracts. Okay, so it's going to vary. And again, the difference between, say, a tick-based chart and a volume-based chart. Volume-based chart is based on a number of volume in a bar. So if you have a 100 volume bar chart, each bar has 100 volume. Whereas if you have a 100 tick chart, the volume in each bar can vary. So as an order flow trader, when you see big volume at a price or prices go through, that should get your attention to dig deeper into what is going on and possibly take a trade. Now, after all, what is happening is you have regular order flow coming in and all of a sudden a burst of volume appears for whatever reason. That is important to see. So let me give you a real life example, right? Our new tool FlowBreaks looks for heavier than normal volume coming in on both sides of the market. Think of it like a volume breakout, hence the name FlowBreaks, in case you're wondering why it's called FlowBreaks. So if you're looking at a normal tick-based chart, in this case, I'm going to look at a 100 tick wheat chart. Do you think knowing where the volume breakouts would be helpful, right? This is a normal 100 tick wheat chart, right? And you can see it's gone up, double top, come off, gone back up, gone back down. So as a trader, right, you sort of want to know where the heavy volume is coming in, and not just where it's coming in, but which direction is that trading going on. And FlowBreaks will highlight that to you, right? Now, whether you're using FlowBreaks or whether you're using a normal footprint chart, it doesn't matter, right? Really, as an order flow trader, you want to see where that volume is coming in. And if you don't have a way to determine, hey, there's heavy volume, buy volume coming in here, you're going to miss that move up. or, heavy sell volume here, followed by heavy buy volume, heavy sell volume to catch this nice move down from 770, all the way down into the 750s. As an order flow trader, that's really what you're focusing in on, is the big volume that's coming into the market, not just the regular transactions that are just, the market facilitating trade, right? You want to be alerted or notice when the big directional volumes are coming in, because that's what's ultimately going to move the market. So the most important thing you have to keep in mind with tick charts is that you can't use the same amount of ticks for all markets. Okay, so for markets that trade lesser volume, I'd start at 100 ticks. For example, wheat, gold, ultra bonds, right? Those markets don't trade as much as the E-minis or the MES or the NQ. So you can't use 1,000 ticks that you'd probably use, in NQ, in wheat, because the volume is much less, right? Just same with gold and ultra bonds, right? Since those markets are inherently have less volume, I'll say inherently have less volume, they do have less volume, you can't use the same amount of ticks as you would for other markets. So, I sort of have it categorized by sort of groups of markets, sort of the low volume markets, the average volume markets, and the heavy volume markets. Now, it doesn't mean you can't trade a low volume market. Of course you can, right? To be honest, the way some of these, what I would consider, quote, a low volume market today, back in the 90s, that was considered heavy volume already. So let's take a look at some charts here, just sort of give you an idea. So I'll pull up a chart. So this is an MES chart, but I'll talk about the low volume markets, right? The wheat, the gold, the ultra bonds. All right, go back to my chart. Here we go. I'll just use this. So this is a 1,000 tick MES chart. Okay, MES trades, over 1 million contracts a day. Okay, but if I was going to look at another market, we'll just go with wheat, right? I can't necessarily really do very much with wheat on a 1,000 tick chart, because, this is the whole day of yesterday, right here. Whereas since the reopen last night to 8:40 in the morning, you only got maybe 10 bars, right? Whereas on the 1,000 tick MES chart, right, this is just, since 8:30 this morning right here, you've got, more bars than you had yesterday in the wheat. So, with wheat, I would go back. I wouldn't use a 1,000 tick chart. I would use, 100. Okay, so this is this morning, in the wheat, right? Just scroll back since last night, the reopen here. For the first couple hours after the reopen up until, midnight, there's not much activity, right? You only got 1, 2, 3, 4, 5, about 10 bars, 12 bars. It's because there's not much activity going on. There's not much trading going on. That's why you got lesser bars. So the more activity you have, the more bars you're going to get. Okay, so this is yesterday in the wheat. Okay, again, that nice move down, some nice move downs. Really what you want to be doing, is, following the action of the market. It's going up. Okay, boom, 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 buy, buy, buy. People will say, well, you got this buy signal that failed here. Really, when you're using a tool like the FlowBreaks, you're going to take the first signal, right? You're not looking to buy after the market had just put in a big rally. You get a buy signal up here, okay? Just as you would take the first sell signal here, here you've got a bunch of sell signals. Don't take this last one and say, oh, you know what, this one failed. Well, really, you should be getting long early. That's the whole point of looking at order flow, is to get in early to a trade. If you just, say you just turned on your computer right here at 10:30, well, look to the left a little bit and see, well, I just had this big move down. Do I really want to be taking this move after you just had almost a 20-cent sell-off? No, you probably don't, because how much is left to that move? I mean, it can go down to hit limit down, but then, where would you rather be looking to get long, after a 20-cent move down, or get short after a 20-cent move down? But again, that just deals with market context. Let's take a look at another market, gold. Okay, gold. This is a 100 tick chart. Again, you see this nice trend down, short, 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 short. Yeah, you do have some it did look like some buying came in here to bounce it back up, but it didn't happen, right? So you still got some moves down, in the gold, right? You can see how it's starting to put in a nice rally here off that bottom. Ultra bonds is a great contract to trade. Let me just scrunch up this chart a bit here. Here's a sell signal right here. Let's go back here. Going back since this morning, 7 o'clock. Ultra bonds, the liquidity pre-New York hours, isn't always that great, but you're seeing some nice moves here, right? Here's a nice move down. There's another nice move down. There's a nice move up, right? It doesn't look like much here, but this is what a move from, the 06, 08 area all the way up until, 18. But this was a nice move here. It's almost a full point here, 187 down to almost 186. Again, another nice big move here. So, when you're looking at these markets, understand the volumes of the market and how it trades, because again, you can't trade every market using the exact same tick chart. When you're using a time-based chart, yeah, you could use a time-based chart, the same 1 minute that you would use on ultra bonds that you would use in MES or MNQ or YM, okay? But when you're dealing with ticks, you're dealing with the number of transactions, right? And so some markets have less transactions, all right? So just, bear that in mind. Now, again, as you start analyzing markets with more overall volume, like crude oil, mini Dow, MES, you're going to need a higher amount of ticks to make up your chart, because the more active the market, the more trading is going on. So a 100 tick chart in MES would be equivalent to trading a 5-second chart. Basically, let's go back to the chart and put up where's my MES here? We'll pull up the MES chart, right? And put the crosshairs on. Okay, so you can see, right? Like from this bar right here, right? 846.36, 846.38 seconds, 41. Well, it's got here, it keeps moving. Example here, 844.58, 845.00, 845.05, 845.07. This is a 100 tick chart, and basically you're getting a bar every 1 or 2 seconds, right? But if you were to bump it up to 1,000, right, now you're giving the chance the market to have more transactions, right? You're going to see here, right, from this high, 840.52, 841.09. Still a little fast. 841.26, 37, 52. So now, a 1,000 tick chart is basically more or less a 15, 20 second chart you're trading. Okay, so maybe you don't want to use a 1,000 tick. Maybe you want to make it 2,000, right? So, or 1,500. So what you do is you just open that up. You could adjust it here. You could add, whatever volume you want. 2,000. Right now, again, this is 2,000 here. So you could, why didn't it save? Configure, tick, add 2,000. If I didn't click, hopefully it'll work. Here we go. 2,000 here. So now you're seeing the 2,000 tick chart. Okay, just open it up. Now it's a little bit more consistent. It's about 840, 30 seconds, 841.09, 37.08. So it's actually coming in about a 30-second chart. Okay, it's a nice move here, nice move here. All right, so understand the market that you're trading, because again, you can't use the same tick amount on every market, right? So, if you're using a high volume market, you're probably going to want to use a higher tick amount. Now, I know some traders like to use an amount of ticks based on fib numbers, 233, 987. Honestly, I don't think it really gives you an edge over any other number, right? They're going to say, well, it's a fib number, okay, and fibs are magical. Fine. That's your prerogative. You could use whatever you want, honestly. All I know is when I go to the barber shop and get a haircut, I don't say, take off you know, what is the number? Don't take off 31.8 or whatever percent off the side. When you cook, right, you use certain measurements. But hey, whatever. If that works for you, it's sort of like the guys that think they've got an edge by using instead everyone's using a 5-minute chart, so I'm going to use a 3.5-minute chart. Give me an edge over them. Okay. Honestly, you're just taking the information and you're just looking at it through a different lens. So that's me. Okay, that's my thoughts. Really what you're looking for is the volume burst, right? Which would appear if you're using a 199 tick chart or a 200 or a 233 or a 250 tick chart, any of which honestly work nicely in crude oil, in case you're wondering where crude oil sort of fits in here. So let's pull up a crude chart. Okay. Well, let me go in here first before I do that. I'll add some of these numbers. So I got 200, 300. All right, I'll add. Go to tick here. I'll add just it's just some random numbers. 190. Well, say random, but I'll go 199. Right. I've already got a 200. I'll move that up. Then I'll add a 233. Okay. Move you up. I'll add a 250. Move you up. And then lastly, I'll just add a 225. Get some numbers just sort of more or less the same. Yeah, again, what's the difference between the 199 and 200, one transaction? 225, 233. Yeah, of course, you get 1,000 lot pop in, and between that eight transaction difference, 233 and 250, more or less the same. So good crude here, crude. Okay. Oops. Make sure I got the right. Yeah. Okay. So it's 2000 tick chart. All right. So we'll start with the 199 tick chart. Okay. So you got that move up here, the move down. But tell you what I want to do here instead of. Okay, this is a 200 tick chart. Basically, more or less, slightly different, right? You got this on the 199. You got this big red candle down here. You don't have it here. Sort of, you got this red. Let's take a look at 225. 225 closer to the 200, more or less the same. Go with the fib 233. Okay, it's the same, more or less, to the 225. This is 233. This is 225. 225 does get you in a little bit earlier there. The 233. You're still catching this move down from the 75, 80 area down to here, and lastly, just throw in the 250. So you don't have the buy here on the 250. Now, again, as you go from the 199, again, that's just a number. I could have thrown in 189. It'd probably be a little bit more similar. But, 199, the 200, 225, 233, 250, very similar. Again, it's depends on your trade. If you're a big fib person, by all means, you use the 233. Now, me, I prefer, whole numbers, 200, 100, 200, 250, 500, equal intervals. I don't jump around, I don't try to curve fit everything, like come out with the 189 or, find out, the 169 tick chart is the best. I mean, you can in the short term, it may work, but or as if you've ever done back testing, right, there's always the problem of curve fitting something. So just bear that in mind, okay? Now, why would you want to use a tick-based chart instead of a time-based chart? Well, I don't look at it as I got to use tick-based or time-based. I use both, right? I look at both. You don't have to give up your time-based chart if that's what you're using, or your Heikin-Ashi chart. Add a tick-based chart to give you a different perspective on the same market, because even though you're looking at this is your crude oil, right? Your tick chart. If you have a minute-based chart, obviously it's going to look much different, right? And you do have the sell here. It's just giving you a different perspective on the same market, all right? Because sometimes, you might be thinking, should I take this short here? Well, on the minute-based chart, yeah, I've got my bearish signal. On my tick-based chart, yeah, I got my bearish signal. It gives you just a different look. It's like having, excuse me, it's like having a second opinion on the market. So you don't have to give one up to use the other one. Now, is there a perfect tick amount for everyone to use? No, there's not. It really depends on the market you're trading and your own risk tolerance. But I do believe there is a right tick amount for you to use, right? And that's going to come down to you sort of doing the legwork, right? I could recommend what I use. I'm a different type of trader than many people. I'm a very short-term trader. So, while I was showing you, wheat, on a 100 tick chart, right? Some of you may not want to use a 100 tick chart. Maybe you want to use 50, because you want to be a little bit faster. I don't think I got 50 on this one. Add it in here. Show you how it. Get in here. 50. Click OK. Where is it? Down at the bottom. Move you up. Top. Click apply. Okay, so maybe you want to use the a 50 tick chart instead, right? Because you're a faster trader. Obviously this is 8:30. This is when the market opens, so you're seeing a lot of trades going through. So you're seeing a lot of bars. But as things sort of slowed down, you got a nice buy here, sell didn't work out, and then you got a nice sell right here into the buy that just sort of went sideways on you. But again, look at it, over previous days to see how the movements are, if it's something that suits your risk tolerance, or not. And another way to determine, should I be using this chart, is sort of look at the time intervals, because if, on some markets, a 50 tick chart or a 100 tick chart would be equivalent to trading a 15 or a 30-second chart, which you may not want to do, right? Because sometimes it could be a lot of volume coming through for whatever reason. So, for example, here's, just look at the time, right? 9:30 and 13 seconds, 34, 00, 12. So, a 50 tick chart in wheat is more or less equivalent to about a 15 to 30-second chart. Figure that out, what you want to be trading, especially, when you're in the indices. Obviously, you're not going to use a 50 tick chart in, MES, because the ticks are going to be, fast and furious. You'd want to use something, a bit higher. I mean, you're seeing here, right? 856, 41, 42, 43. A 50 tick chart in MES is basically a 1-second chart. You probably don't want to be doing that. You'd want to start using higher numbers, right? By understanding, what the market is, right? Even if you're on a 500 tick chart, okay, what's a 500 tick chart basically equivalent to? 20 seconds, 24, 30. This is about a 500 tick chart is, about a 5-second chart, more or less. All right, so you go higher, 100, 1,000, 2,000. But ultimately, at the end of the day, it's about finding the right tick amount for you and your style of trading, because everyone's got a different style of trading. Okay, and once you understand that, then stick with it, right? But you should use a tick-based chart to complement your other existing chart that you're already using and you're successful with. Now, if you're interested in that FlowBreaks indicator, which I used in this presentation, just go to www.flowbreaks.com to get started. And hopefully you found this video useful? If you did, give it a thumbs up. Leave your comments below. Thank you and have a great day.